Welcome to the Compliance 911 Show, a no-nonsense podcast discussing hot topics for today's busy compliance professional. It's everything you wanted to know about regulatory compliance, but we're afraid to ask. And now, here are your hosts, Dean Stockford of M&M Consulting and Len Suzio of Geodata Vision.
Welcome to Compliance 911, the show where we break down complex regulations and regulatory updates into practical insights the audience can actually use. I'm Len Suzio with Geodata Vision, and I'm joined today by Dean Stockford of M&M Consulting. So, Dean, what interesting topic did you bring to the audience today?
Well, good morning, Len. It's always great to see you. Figured, in March, the FDIC released its Consumer Compliance Supervisory highlights. So I thought it would be good to unpack that for our audience today.
I think that's a great idea. Too often, people are too busy and gloss over the highlights without getting into the weeds to fully understand. So I like your approach. Go ahead, Dean.
Well, thank you. And basically, the highlights represent a report card on how banks did over the last year.
Well, that's interesting. A report card on regulators.
Yeah. No, not really. It's actually a report card on the banks as determined by the regulators. But
I thought it was reverse role playing for a minute there. Well, I think that's a great idea. Let's jump into this high-level overview. So, what did the FDIC actually say about overall performance?
Well, I'll start off by saying, spoiler alert, it's mostly good news. So kudos to those banks. However, baked into the highlights were some pretty important warnings.
Okay, well, then let's jump right in.
Well, as I mentioned, overall banks did very well. In fact, 98% of FDIC-supervised institutions were rated satisfactory or better for the consumer compliance.
Well, you know what? 98% sounds pretty good to me, if not outstanding. Shouldn't we just stop here and celebrate?
Yeah, you would think, but not quite. The FDIC makes it clear when banks don't perform well, it's usually the result of weak compliance management systems and often leads to actual or potential consumer harm. Some familiar with our podcast and CMS will know that I've discussed over many different podcasts to include compliance management systems last month in how that applies with artificial intelligence.
Well, you know what, Dean? I can recall the last few episodes you discussed CMS. It boils down to something pretty simple, doesn't it? So strong systems equal good results, and weak systems equal elevated risk and problems.
Yeah, exactly. That's really the underlying theme of the entire report.
So can you tell us where banks are still getting tripped up or what the biggest compliance issue is?
Absolutely, Len. In total, the FDIC identified 1,155 total violations, and 5 regulations made up about 75% of all those violations. So as you can see, I would certainly focus on that those 5 regulations.
Wow. Only 5 regulations account for 75%, 3/4 of all violations.
Yeah.
Boy, that seems pretty high.
Yeah, I would agree, Len. Yeah, and it's also pretty concentrated, and 3 of the 5 are related to lendings.
Oh, that's my experience in my area. So what are those 5 areas, Dean?
Well, here are the top 5 and the number of violations that are, that they identified in the report. The big one being truth in lending. There were 462 violations, and a lot of that has to do with what we call the integrated disclosure rules that were put in place and the ticking and tying on the closing disclosures and loan estimates. Electronic Funds Transfer Act. There were 135 violations, and a vast majority of those had to do with timeliness. Flood, still not really, I say regulations around it, but they're made up of a series of laws. So there were 131 violations, and regulators like that one. Truth in Savings, 74 violations. Those typically have a lot to do with disclosure requirements. And then last but not least is the Home Mortgage Disclosure Act, and there were 72 violations there, primarily because of the ticking and tying, again, reporting on specific line items on the law.
So it sounds like to me that disclosures and transparency appear to be huge themes here.
Well, exactly. Just like I mentioned a minute ago on TILA, or better known as the Truth in Lending Act. The provisions are all about making sure that borrowers fully understand the true cost of their credit. So basically, all the loan costs. The most common issue cited in that FDIC report was missing or inaccurate or disclosures, especially around the closing disclosure, as I mentioned before, the integrated disclosure rules. Other issues that they saw was timeliness for delivery of the truth in lending disclosure, which is extremely strict timing. And oftentimes people get business day concepts wrong, so on and so forth. Disclosing the total payments, finance charge, amount financed, APR, and total interest percentage on the closing disclosure. Once again, disclosing those line items, and there's a there's a prescribed format for doing so. So very easy to let our guard down, become complacent, and to have those level of issues.
What about EFT, Dean? A few minutes ago, you mentioned that it jumped up to number two in the frequency of violations cited this year in the FDIC report.
Yeah, and that's very important, as many of the violations are the result of bank procedural breakdowns in timeliness, as I indicated before, for responding to those EFT errors. Banks weren't investigating their disputes, their Reg E disputes, timely. So if you have a particular dispute that a customer has raised with the institution, there are very strict timeframes for how we were need to respond, very strict timeframes for investigations and how long those can take, or if we extend them. Communicating the results of the investigations, again, very strict timeframes for communicating those results, and then very strict timeframes for correcting the errors within a prescribed format and timelines that have been established by regulation.
Well, that appears to be tied to customer experience. Am I correct?
Well, that's a great observation, Len. In the digital world with instant payments and digital banking, the error resolution process is front and center. When banks fail here, customers feel it immediately.
Hmm. I know we are limited on time, but can you briefly expand the other areas included in the highlights?
Yeah, sure. As I mentioned before, the hot areas include flood. And one of the areas that are one of the specific provisions within flood has to do with adequate coverage and the calculation of that coverage, making sure that we arrive at what we call the insurable value. And that can't be done after the fact. That has to be done prior to the loan closing, and proper notification has to be provided. A policy has to be in place. There's a whole bunch of things that come into play there. So flood continues to be a real big one. Truth in savings disclosures, accurate disclosures. We're seeing, in addition to Truth in Savings Act violations, you can also add UDAP, or unfair, deceptive, and abusive acts and practices, under the same thing, because we see inaccurate disclosures between, let's just say, the website and what they hand to their customer, what they hand to the customer, and what actually happens in practice. So those are the types of things that they're seeing with Truth in Savings. HMDA has always been one of those areas, as you know, Len, that's been just a major hot topic with regulators. And the information that we disclose on the loan application register has to be accurate. If it isn't accurate, then it's damn near impossible to conduct any type of meaningful fair lending data analysis, which would result in skewed results and most likely a failed report for fair lending. So it is critical that we scrub our HMDA LARs and that we review the information within the walls of the file to ensure that the data fields on the loan application register are accurate. And then, of course, this is one you're going to hear about for over the next many years. And that has to do with third party oversight. And, it's not just your traditional vendor due diligence in documenting, oh, do they have insurance? Do they have safeguards in place for cybersecurity? It's going beyond that. It's also, what are the tools that they're using for our institution? How do they protect non-public personal information, so on and so forth. So, again, all of these areas are extremely hot according to the FDIC report. And I think it's important that people digest that and certainly adjust procedures as needed.
But Dean, I think this is another outstanding podcast, and I'm certain our audience appreciates you breaking down the FDIC violations report for us today. Do you have any parting words for our listeners?
Well, sure, Len. You know me; I always have a little bit to go. So let's go ahead and land the plane, as they say. These are in no particular order, but I think 5 takeaways from today that are important. Compliance performance is strong, but obviously there's a level of fragility. I think that most banks are doing well, but breakdowns still happen quickly with weak systems. So obviously, or controls. So institutions have to, as they say, sharpen the saw. Disclosures still drive risk. So your Truth in Lending Act disclosures, the Truth in Savings Act disclosures, as I indicated before, they show basic communication failures, and we need to make sure that we get those disclosures right. What is it that we're doing? What are the features of the account? And make sure that that's consistently applied throughout. Error resolution is under the microscope, especially for digital banking, and we're seeing more and more and more of that. So, very important to address your procedures, ensure that there is a level of consistency and accuracy with the regulatory provisions, and making sure that appropriate training is conducted with staff. Operational execution matters for sure. Flood insurance and HMDA show the process discipline is extremely critical. So once again, the ticking and tying and making sure we've done everything right from a procedural perspective will ensure compliance. And then third-party risk is accelerating, as I continue to talk about. So vendor oversight is no longer optional. It is essential. And of course, again, a moving target. So constantly having to improve our vendor due diligence overall for third parties.
Well, Dean, I want to thank you for unpacking this extremely important FDIC violations report for our listeners today. I'm certain many of our listeners will probably be provoked to go back and actually read the report itself, which is going to be a very important thing to stay on top of what's going on so your bank can avoid appearing on those violations. This is Len Suzio with Geodata Vision.
And this is Dean Stockford from M&M Consulting saying thank you for listening to today's podcast. Please let us know of any topics you'd like to hear in future episodes.
Thanks for listening to the Compliance 911 Show. If you like the podcast, be sure to subscribe so you don't miss an episode. While you're at it, please give us a like and review to help others find the show. As always, links are in the show notes, and you can always find us online at compliance911show.com. Follow M&M Consulting and Geodata Vision on LinkedIn for all the latest news and information on compliance hot topics.